Hello and welcome back to episode 4 of my brand new journey. This journey is going to document my Freetrade realistic UK dividend investing journey. In this series, I'll be documenting my real-time progress as a UK dividend investor using the Freetrade app with a focus on building a UK-based portfolio from scratch. This portfolio is going to be a smaller portfolio as I've recently been getting so many messages from people who are struggling with a smaller dividend portfolio, so I thought what better way to help them than create my own UK dividend portfolio on Freetrade. I know when you see a portfolio that's over 20, 50 or £100,000, it can feel totally out of reach, so hopefully more people can relate to this portfolio, and I want to keep this separate from my main portfolio on Trading 212, but I still want it within an ISA, so that's why I decided to use Freetrade. On Freetrade, they have recently made their ISA account available on the basic plan, which means you can now open one completely free. If you don't already have a Freetrade account, I'd really appreciate if you use my link in the description. By doing so, we'll both get a free share worth anything between £10 and £100, and all you need to do is open the account and deposit £50. If you're still on the fence, hopefully these videos will show you just how simple and accessible the app really is, and why it's a solid platform to get started with. For this series, I decided to set out a few rules to make it as fair as possible. The first rule is that every stock I invest into has to be listed on the London Stock Exchange. For this challenge, I've decided to only use stocks listed on the LSE to keep things focused, relatable, and beginner friendly, especially for UK investors. Since I'm using a UK-based brokerage and building this portfolio from a UK perspective, sticking to LSE stocks helps make it easier for beginners to follow along using the same tools, and it will highlight UK dividend paying companies that often get overlooked in global investing content. The second rule is that I can only deposit money into this account that I've made through this YouTube channel. So if you're watching, please hit the like and subscribe button, as it really helps the channel out and you'll be directly contributing towards the series. By doing this, it means I have a capped limit to what I can invest each month, and it will vary month to month depending on my YouTube earnings. Hopefully this will make it a lot more relatable, and by this I mean that some people can only invest bits and pieces into the market, and I want to show you all that as long as you stick to it, you can make a huge difference to your future. In the last episode, I mentioned that I was planning to open a new position in the portfolio by adding a REIT. I broke down the pros and cons of Segro and Sirius Real Estate, then left it up to you to decide which one should make the cut by liking the comment of your preferred choice. And the results are in. With 25 votes for Segro and only 8 for Sirius, there was a clear winner. You wanted Segro added to the portfolio, so that's exactly what I'll be doing later on in today's video, so stay tuned for it. And finally, the third rule is that there are no more rules. So whether you're just getting started or looking to follow someone on the same path, this is a transparent, no fluff look at how I'm learning to invest for long-term passive income through dividend paying stocks. If this video reaches over 150 likes, then I'll be sure to continue the series, as it will confirm that there is enough interest for this type of content. Like I mentioned earlier, I'll be using my YouTube earnings each month to fund the series, and as you can see on screen, last month the channel brought in £203.62, and that's exactly what I've added straight into the portfolio. That now leaves me with just over £206 sitting in the account, ready to be invested. If we have a look at how the portfolio has performed over the last month, we can see that it's up just over £15. It was actually up over £25 just a few days ago, but has since dropped back off, but I'm still pretty happy to see that it's had a 2.3% return over this period. When zooming out and looking at since I first started, we can now see the portfolio is up around 4.23%. With this series, ideally, we will be able to outperform the FTSE 100 over a prolonged period of time, so it's nice to see that over the last 2 months, we've actually been able to outperform it, albeit only just last month. We are slightly underperforming it in November so far, but it's very early days, so we'll come back to that in the next video. And over the last month, we can see that all of my positions, except for Domino's, ended up in the green. Come on everyone, can you start getting those pizza orders in? And if we zoom out to the overall look, we can see that we have got 2 stocks that are in the red, which is Domino's and Pets at Home, but every single one of my other positions is currently up, and considering we only started the portfolio 3 months ago, I'm pretty happy to see this progress so far. Now, the whole idea behind this portfolio is to build something focused on reliable UK-based dividend payers, something that can grow steadily over time while also giving us a nice stream of passive income. To make that happen, I wanted a strong UK-focused ETF as the foundation. On my other investing account, I don't actually have any UK-based ETFs, so this is the perfect chance to gain that exposure, especially since this series is all about UK investing. The ETF I've chosen as the core of this portfolio is the iShares UK Dividend ETF, stock ticker IUKD. Now, this ETF specifically targets the highest yielding UK dividend stocks across a broad range of companies, not just the big names. That means we get a higher average dividend yield, broader sector exposure, and plenty of liquidity for easy buying and selling. It's even outperformed the FTSE 100 over the last 1, 3, and 5 years, which is pretty impressive. So for a portfolio that's built to generate income and reinvest those dividends for growth, IUKD just makes sense as a core holding. That's why I'm going to add to my position today and continue building it out every single month. I'm going to add 5 more shares for a total amount of £45, and at the end of today's video I will reveal how much income my portfolio is generating both monthly and yearly, so you'll want to stay tuned for that. For the individual UK dividend stocks in this portfolio, I'm not just picking them at random or going with whatever looks good on the day. I'm using a screening process on Stockopedia, and this is where it gets interesting. Stockopedia allows me to set up filters to find companies that match my exact investing criteria. For this series, that means looking for solid, financially stable businesses with a track record of paying and ideally growing dividends over time. I can filter by things like dividend streak, stock rank, payout ratios, and even long-term earnings trends. That way, I'm not just chasing high yields that could be unsustainable. I'm aiming to invest in companies that can actually grow their dividends over the long term while still keeping their business strong. This process then gives me a short list of quality dividend growers, which I can then research in more detail before adding them into the portfolio. Over time, the goal is to build a dividend income stream that's not only high, but also reliable and growing year after year. We can see that my current filtering process has led to 30 stocks, and from these, I then looked into each company further and carefully selected them. If you're also a serious investor, then please check out the link in the description for a 2-week free trial on Stockopedia and a further 25% discount if you do decide to sign up. The plan with the remaining funds for today's video is to top up some of my existing positions and, of course, open up that new position in Segro. So let's start off by opening that new position up in Segro. And since I mentioned them in the last video, the stock is actually up over 4%, so hopefully it will continue to carry that momentum forward. They have a yield at around 4.3% with a very nice dividend growth rate at 7.6% and a solid 9-year dividend growth streak. Year to date, we can see they're almost flat, being down 0.74%. The analyst consensus is that right now it's a buy with a price target at 756p, which is 8% above the current price. Their stock rank is on the lower side at only 52, but if we compare this to earlier this year, we can see that it's actually been steadily rising. And I'm going to be adding a total of 7 shares for an amount of £50. Actually coming out at £48.97. The next stock I'm adding to this month is going to be my Drax position, and over the past month they are up just over 1%, and they have a yield that currently sits at 3.79% with a very nice 5-year dividend growth rate at 10.28%, and they also do have a 9-year dividend growth streak. Year to date, we can see they're actually up over 10%, so hopefully this will continue on for the remaining of 2025. The analyst consensus is that it's currently a buy with a price target at around 800p, which is around 11% above the current price. And we can see they actually have a very strong overall stock rank score at 95. In today's video, I'm going to be adding 5 shares for a total amount of £36. The next stock I'm adding to this month is going to be my Domino's position. This one already takes up around 16% of the portfolio, which is on the higher side. However, since I've just started the portfolio, I don't mind taking advantage of better prices when the opportunity rises, as long term my goal will be to have all my single stocks at under 10% of the portfolio, so I have a good level of exposure but also still have diversification. So the plan will be, while the stock is still underpriced in my opinion, I'll continue to top it up, and then hopefully as the price starts to rise again, I can top up different positions throughout next year, and then this allocation size will come down to around that 10% mark. Over the past month, they're down 2.44%, and they do pay a big yield, the second biggest in my portfolio, at 5.78%, and they have a 3-year dividend growth streak with a 5-year dividend growth rate at 2.09%. Year to date, the stock is down nearly 39%, hence why I think it's such a fantastic buying opportunity. Right now, the analyst consensus is that it's around about a buy with a price target at 301 pence, which would be around 54% above the current price. Their stock rank is on the lower side, mainly due to that share price drop because their momentum score is pretty much as low as it can get at 5. So personally, I just see this as a fantastic opportunity. I'm going to be adding another 12 shares for an amount of £23.12. The next stock I'm adding to this month is going to be my Hikma Pharmaceuticals position. Over the past month, it's basically flat, being down 0.6%, and they have a phenomenal 5-year dividend growth rate at 14.32%, with a dividend yield that currently sits at 3.48% and a very nice 7-year dividend growth streak. Year to date, they are still down around 8%, and that's exactly why I want to take advantage of the current price. Right now, the analyst consensus is that it's between a buy and a strong buy, with a price target at $32.15, which is around 33% above the current price. I'm not sure why this one is showing up in dollars, as it is listed on the London Stock Exchange, so I'm going to speak to Stockopedia about that and find out why. Their stock rank is good and just outside the fantastic range, with it being at 78. I'm going to be adding 2 more shares for an amount of £36.78. This now leaves me with around £17, so the final stock I'm going to be topping up this month is Pets at Home. Over the past month, they've actually seen a 1.73% price increase, and year to date, they are up 2.82%. Their dividend yield is the highest in my portfolio at 6.15%, and they do actually have a very respectable 5-year dividend growth rate at 11.63% and a 4-year dividend growth streak. The analyst consensus is that it's around about a buy right now, with a price target at 243 pence, which is 13% above the current price. They also have a really strong stock rank score, with it being 86, and we can see that it's been up 6 points over the last 30 days. With that final £17, we can just about buy 8 shares of the stock. Now, let's take a look at how the portfolio is shaping up over on Snowball Analytics. As you can see, in September, I received over £3 in dividends, and then if we look at last month, I received over £1 from Drax Group on the 24th of October. Looking ahead, I've got no payouts in November, but in December, I've got a little late Christmas present from my ETF in the portfolio, and they're going to be paying me around £2.23. What's exciting is that I only opened this account 3 months ago, and we can see that I'm already on track for making over £40 on an annual basis. And with the consistent monthly contributions I'm going to be showing you each month, I know that this number is only going to keep growing. What I really like about this portfolio is the balance it offers. It's got a current dividend yield that sits at 4.5% and has a 5-year dividend growth rate at an average of 9.27%. And with that, it's going to wrap up today's video. If you made it this far, then please let me know what stocks you think I should look at to add next month. If you enjoyed the video, don't forget to like and subscribe. Thanks for watching. This is the Geordie Pig Investor. Over and out.